Hello, on behalf of Mountain West and myself, we would like to welcome and thank you all for attending our webinar presentation today. Our goal today is to give each of you the knowledge and the tools to help take yourself, your company, and the loan officers you process for to the next level. With that being said, let's go ahead and get started with today's presentation. The purpose of a Streamline FHA loan. They're designed to lower the monthly principal and interest payment on a current FHA-insured mortgage. Streamlines can be made without an appraisal. Some of the benefits of a Streamline Refinance is that it decreases the borrower's monthly payment without incurring additional costs, reduced documentation requirements resulting in faster processing, expedited underwriting. May be used by investors and non-occupant borrowers. It does not need to be ran through DU, and no 4506T is required. Let's take a look at the Streamline checklist, or what you're going to need to obtain for the file. We're going to need the Mountain West submission sheet, net tangible benefit to the borrower worksheet, final/typed 1003, final addendum to the Uniform Residential Loan Application 92900A, pages 1 through 4, the original handwritten or less signed dated by borrower and the loan rep, initial addendum to Uniform Residential Loan Application 92900A, pages 1 and 2, most recent tri-merge credit report with current mortgage rating, no 30-day lates on any mortgage accounts in the last 12 months. Also, a 640 minimum credit score is required. We'll also need current demand with only 30 days of interest charged to the borrower. Copy of the existing note or proof of current interest rate, copy of coupon or statement evidencing the dollar amount of the HOA fees, and proof of the PUD or condo name, if applicable. Proof that the condo project is FHA approved, or proof that the previous FHA case number has been insured. Processor certification to certify all bank statements submitted with the file or provide blanket cert. Now keep in mind, if you're doing a credit qualifying Streamline, the blanket cert will have to also cover income documentation. We'll also require 2 months bank statements for proof of funds to close. Must track and source all large deposits and provide LOEs. We'll also need a copy of the hazard insurance policy, estimated HUD-1, escrow instructions with vesting, including certified escrow amendment for the lender rate, term, loan amount, MIP refund credit, if applicable. Prelim with 24 months chain of title, address supplement, and plat map. And please note, borrowers must be on title for a minimum of 6 months. Clear copy of Social Security card or evidence of Social Security number for all borrowers. Provide documentation evidencing borrower's identity, i.e., you could provide a copy of the driver's license or just an identification card. Case number assignment from FHA Connection with borrower's validated MIP refund credit if applicable. And then, of course, your forms, important notice to home buyer, EM disclosure if you're doing an EM loan, credit authorization, informed consumer choice disclosure, broker credit score disclosure form, notice of intent to sign, and dated by all parties, settlement service provider list if applicable, change circumstance form if required, itemization of amount financed or fee worksheet, good faith estimate, MLDS Form 882 signed and dated by all borrowers. And now please keep in mind, we are going to be updating this form, so we are only doing FHA Streamlines without appraisals at this time. Let's talk about FHA case numbers. You need prior FHA case number information in order to order the new case number, broker or branch to order unless sponsored by MWF. Please note, 213 days from the first payment date before case number can be pulled. Borrower names in FHA Connection must reflect exactly as names will reflect on title / in the vesting. How do you pull a case number? Well, you're going to go ahead and log on to our website. You're going to click on Business Partners. You're going to go into the login. You plug in your username and password. Once you're into the site, you're going to go ahead and click on FHA case number. And then that's going to prompt you to all the information you'll have to input, hence the old case number, in order to obtain the new FHA case number. You'll also need to pull the refund authorization results. This is the information you're going to need when working up your loan amount worksheet. So here's a sample of when you pull the refund authorization form. This is the information you're obviously going to pull to place on that form. You're going to need to know the property value, your unearned MIP, and for case numbers that are going to be pulled on or after June 11th, your upfront MIP factor will be listed up here. And you're also going to look for the original endorsement date if you're looking to take advantage of the new guidelines for case numbers pulled after June 11th. So let's take a look at a refund authorization form for a case number that was pulled before April 9th. So in this case, upfront MIP factor is 1%. This loan was closing, let's say, in November of last year. So we're going to be looking at this information down here. And you're going to take, again, the property value and the unearned upfront MIP. And in this case, they have 0. And then your annual MIP factor is going to be determined upon your loan to value. So again, here's the information that's vital for the worksheet that we're going to be going over shortly. So let's talk about calculating loan amounts. The mortgage being refinanced must be current for the month due. Example, a refinance of a mortgage anytime in November must have the October payment made. Includes 30 days interest only. Borrower to pay delinquent interest, late charges, or escrow shortages out of pocket and provide explanation. So here's a simple calculation. You're going to take your current principal balance plus 30 days interest. You're going to subtract the MIP refund credit for that month's closing, and that's going to give you your max base loan amount. Loan amount may be lowered if requested, but keep in mind borrower will have to pay the difference if you are lowering the max base loan amount. So here's a sample of a demand. Now this demand is dated October 31st of last year. You're going to take your principal balance, and one thing to look at on here first and foremost is always make sure when you're reviewing the demand that it only lists 30 days worth of interest. A lot of times the demands might have 2 months, even 3 months worth of interest. So just to take this number right under the unpaid principal balance would be giving you the wrong calculation. So rule of thumb, and underwriters will always do this, is they'll take your unpaid principal balance, in this case $119,074.13. You're going to multiply that by 30. Then you're going to multiply it by the current interest rate of the loan, and in this case it's 5.5%. And that's going to give you a total. You're going to take that total and divide it by 360. And that's going to give you 30 days worth of interest. So in this case, if you look on this form, interest from 9/1 through 10/31, there's 2 months worth of interest there. You could take, the amount just divided by 2, but this calculation is always going to give you 30 days worth of interest. So in this case, 30 days is actually 545, and let's round up 76 cents. So again, unpaid principal balance. And that's the amount you're going to place on this worksheet. Then you're going to take your 30 days worth of interest, and in this case, we decided it's $545.76. You're going to total that, and you're going to get $119,619.89. Then you're going to subtract your MIP refund credit, and in this case, they have none. You're going to place a 0, drop down your total. When dropping that total amount down to your max base loan amount, you're going to drop the cents. So in this case, you're only going to plug in $119,619. You're not going to round. You're just going to simply drop the cents. And in this case, since the FHA case number was pulled, let's go back. It was pulled, after April 18th. It is a streamline, so it's a 1% upfront MIP. And we're going to determine the monthly in just a second. So you're going to take your 1%, you're going to add that to your max base loan amount. It's going to give you $1,196.19. That's going to give you your total max loan amount of $120,815.19. So again, you're going to take your case number, and in this case it was pulled October 5th, 2011. The appraised value was $136,300. So in this case, you're going to plug that number in, and what you're going to take is you're going to go base loan amount, $119,619, divided by your original appraised value of $136,300, and that's going to give you a percentage. So in this case, the loan is at 87.8 on the LTV, which then puts you at 1.10 for the monthly. Now keep in mind the loan will have to meet a net tangible benefit. So let's go, let's address what the net tangible benefit is. It's a 5% reduction to the principal and interest of the mortgage payment plus the annual MIP, or refinancing from an adjustable rate mortgage ARM to a fixed rate mortgage. Please note, reducing the term of the mortgage in and of itself is not a net tangible benefit. And you could always please refer to HUD Mortgagee Letter 2011-11 for full details. Now, for case numbers that are going to be pulled on or after June 11th, for jumbo loans, FHA is also exercising its pre-existing statutory authority to add an additional 25 basis points to mortgages with base loan amounts exceeding $625,500. This change is effective, again, for case numbers assigned on or after June 11th of this year. So below you'll see a chart. So any loans above $625,500 pulled after June 11th of 2012, the annual monthly insurance premium is going to go to 145 basis points. That's for, again, loans $625,500 that are less than or equal to 95%. Anything above $625,500 that are greater than 95% pulled on or after June 11th, the monthly MI is going to go to 150 basis points. And just as an FYI, for all forward Streamline refinance transactions that are refinancing FHA loans endorsed on or before May 31st, 2009, the annual MIP will be 55 basis points. So instead of like our previous worksheet that we just did that was 1.10, if the FHA case number is pulled on or after June 11th and the case assignment for that particular loan was endorsed on or before May 31st, 2009, then the monthly MIP is actually going to be 0.55 as opposed to the 1.10. So let's talk about upfront mortgage insurance premium. One thing to keep in mind is that either it has to be entirely financed or entirely paid in cash. Monthly MMI is based on the LTV using appraised value reflected on the MIP authorization and the term of the loan, new final loan amount over the value, or divided by the value. So again, case numbers pulled after 6/11/2012, your upfront MIP is going to be 0.01. And then depending on where your LTV lies, regardless of the fact, it's going to be 0.55 on the monthly MI. And that's also for streamlines that are less than or equal to 15 years. Case numbers pulled after April 9th of 2012, upfront MIP went from 1.0 to 1.75%. And then depending on the LTV, if you were less than or equal to 95%, you had a 1.20 on the monthly MI. And if you're greater than 95%, you're at a 1.25. And then for anything less than or equal to 15 years, you are at 0.25, and then you're at 0.50 if you're greater than 90%. So now, one thing to keep in mind is the new total mortgage payment must be 5% lower than the total mortgage payment for the mortgage being refinanced. Let's take an example. Let's say you have a total mortgage payment of the existing FHA insured mortgage is $895. The total mortgage payment for the new FHA insured mortgage must be $850 or less, because that will give you the 5% benefit. And one thing to keep in mind when going from an ARM to a fix is that you do see page 2 of the net tangible benefit worksheet, because it'll tell you depending on whether or not the loan is currently in its fixed rate period, whether or not it still has to meet the 5% or not. So there is a chart depending on where the ARM loan is at currently, and what benefit it actually has to meet. So let's take a look at the net tangible benefit worksheet. What you're going to be doing here is basically comparing the old loan versus the new proposed loan. So for benefit test number 1, you're going to take your current principal and interest payment, and you're going to take that from the note if you have a copy of the note, or you're going to and you're also going to need a copy of the mortgage statement so you can see what they're currently paying on their monthly MI. So in this particular case, this loan had a principal and interest payment of $771.40. Their monthly mortgage insurance is $49.03 for a total of $820.43. The proposed loan is going to call for a principal and interest of $594.03, and their new monthly mortgage insurance is going to be $109.90 for a total of $703.93. So how do you calculate the benefit? Well, you're going to take your $820.43 and you're going to subtract the $703.93. That's going to give you a difference of about $116.50. You're going to take that total and divide that over your current principal and interest plus MI. So you're going to take your $116.50, divide that by $820.43, and then that's going to give you a percentage, or it's going to give you a factor, and in this case it's 0.0142. You're going to take that amount, times it by 100, which will give you your benefit. So in this case, this particular loan has a 14.2% benefit, so it obviously meets the 5%, so we're good to go. And this is the worksheet I was telling you guys about. So in this case, let's say we have a hybrid ARM, so let's say it's 5-year, and it's during its fixed rate period. So currently the file is still in its fixed rate term and it's not looking to change anytime, within the next year or so. In this particular case, in order for this to be, refinanced, it still has to meet a 5% benefit. So depending on where you are and what you're trying to convert the file into, it'll tell you which benefit it actually has to meet. So it's very important that you do obtain a copy of the note so you know exactly what type of loan the borrowers currently have. The following applies to all streamlines. It must involve no cash back to the borrower except minor adjustments at closing. It may never result in excess of $500 cash back, otherwise it must be a principal reduction to the new loan amount. LDPGSA is to be checked on all parties. Keep in mind we just updated our list so you can go online and it'll tell you specifically which parties you'll have to pull for on the LDPGSA. HUD does not require a credit report, but MWF requires full tri-merge credit on all borrowers. All mortgages being refinanced must have 0 30-day lates in the last 12 months, no exceptions. Short sales, foreclosures, and BKs follow FHA guidelines. And please remember to provide a copy of the current hazard insurance policy. If minor charge-off or collections are reflected, payoff is not normally required, but it is up to the underwriter to review. Loan amounts may never exceed the statutory limits for the county except in the amount of the new financed MIP. You may never include accrued late charges, escrow shortages, subordinate lien repairs, or delinquent interest. This particular loan requires a 640 minimum FICO score for all borrowers, no exceptions. When removing someone from title, streamlines are manually underwritten and must conform to the 31/43% ratios and are considered a credit qualifying streamline. So now let's go ahead and talk about assets. To be from savings under checking accounts, we can obtain a VOD so as long as we have 1 month current bank statement in the file, or you can provide 2 months current consecutive bank statements, all pages reflecting previous and current balances. Any large non-payroll deposits require a letter of explanation and backup documentation. And please keep in mind, currently Mountain West Financial does not offer interest-free advances. So here's just a sample of the 1003. You're going to fill it out completely. We no longer require for the borrowers to list the income on the 1003. But we do, however, still need the current monthly, the current present housing payment, and any taxes, insurance, and HOAs if applicable. We will need assets, so if your borrower is having to come in with cash to close, you will have to list the assets. We're only requiring for the mortgage to be listed on the liability section. So if the borrower owns more than one property, all mortgages will have to be listed as well as the REO section. And then under the details of transaction, please be sure to input the MIP refund credit. Again, we're not doing interest-free notes, and if you're doing any form of lender credit, it's usually a good idea to go ahead and place it on your details of transaction so the underwriter knows exactly what numbers he or she has to work with. And then on your 92900A form, just want to make sure that you click on the appropriate boxes, that the loan officer signs and dates the form, as well as the borrowers, and that they fill out the occupancy status. On your LT, please be sure to, again, list the appraised value, and in this case, you can leave that blank, obviously, because the refund authorization form is going to have it, but if you wanted to go ahead and fill it out, go ahead and do so. And then also make sure that you click that you're doing a streamline without an appraisal. And any comments that you may have or any special instructions that you may have for the underwriter, please be sure to write that on your submission form. Now, for any FHA Streamline forms, you can go on our website at www.mwfinc.com, click under Forms, under FHA, and then you'll be able to obtain the FHA Streamline checklist, the net tangible benefit worksheet, and then the Streamline Refinance without an appraisal. And those forms will be updated in our website. And one quick thing before we end this presentation, just wanted to give the processors a heads up that when calculating your loan amount, it's very important that you're going to be comparing your max base loan amount to that of your demand and the actual payoff. So let's say that the demand has a payoff of $175,688 and some change, but our max base loan amount for our new loan is $174,634. In this particular case, the borrowers are short to close $281. So you're basically going to take your payoff that's on the demand, and mind you, the demand should only reflect 30 days worth of interest. So take that total, in this case, let's say it's $175,688.78. And you're going to compare that to your max base loan amount of $174,634. Then you're going to subtract that, and you're going to see that you're short $281 to pay off the current loan. So the borrower will have to show enough funds to cover that shortage for the payoff of the current loan. So it's just very important that when you're calculating your forms that you're looking onto this and making sure that the borrowers have enough assets. So just wanted to bring that up to your guys' attention. If you guys have any questions, you're more than welcome to always contact one of the underwriters that underwrites Streamline Refinances. So that concludes our presentation. Thank you for attending today's presentation on Streamline Refinances. If you have any questions regarding material covered today, please contact your MWF account executive. Thank you.